How does global trade impact currency, exchange rate sensitivity? Have you ever wondered how global trade shapes the way currencies react to changes in the market? Let's break it down in a straightforward way. Currency exchange rate sensitivity is all about how quickly and significantly exchange rates respond to shifts in global trade. This sensitivity is influenced by several factors that are essential for anyone involved in stock trading and options related to currencies. First off, exchange rates show how much one currency is worth compared to another. This value directly affects the prices of goods and services traded across borders. When a country exports more than it imports, it usually ends up with a trade surplus. This surplus can strengthen its currency since foreign buyers need that currency to pay for those exports. On the flip side, if a country imports more than it exports, it faces a trade deficit. This situation can weaken its currency because more of its domestic currency is sold to purchase foreign goods. Such changes in currency values can impact how competitive companies are in the global market, which in turn affects their stock prices and the value of options tied to those stocks. Next, let's talk about how changes in exchange rates can influence the earnings of multinational companies. When a domestic currency strengthens, it can lower the value of foreign revenues when those earnings are converted back. This reduction can lead to lower profits, which may affect stock valuations. For options traders, grasping how currency fluctuations impact earnings is vital for accurately pricing options on stocks that have significant international exposure. Additionally, the volatility of exchange rates plays a role in trade volumes and investment decisions. Over the medium to long term, real exchange rate changes can significantly impact how much is exported or imported. This shift can alter the economic outlook for companies engaged in global trade. However, short-term volatility tends to have a smaller effect on trade volumes but can create uncertainty. Options traders often factor this uncertainty into the premiums they set due to the increased risk. Interest rates and monetary policies are also connected to exchange rates. For instance, when interest rates rise in a country, it can attract foreign capital, which strengthens that currency. While this may seem beneficial, it can also make exports more expensive, reducing competitiveness. This scenario can affect stock performance and the valuation of options on those stocks. For those involved in stock trading and options, understanding these dynamics is essential. Currency exchange rate sensitivity impacts the fundamental aspects of companies involved in international trade. Traders can use this knowledge to predict how currency movements might affect stock prices and option premiums, especially for businesses with significant foreign sales or costs in other currencies. In practical terms, options traders should keep an eye on currency trends and trade balances to anticipate potential shifts in exchange rates. They might also consider using currency options as a hedging strategy or incorporate exchange rate risk into their equity option positions to manage exposure effectively. In essence, global trade significantly influences currency exchange rate sensitivity by affecting trade balances, corporate earnings, trade volumes, and investor behavior. Understanding these factors is crucial for assessing risk and opportunity in companies that operate in international markets.